is now trading at its lowest level since the U.S. dollar since November of 2020. It is down, as you can see, by well more than a full U.S. cent against the greenback. It's down by 1.13 cents U.S. versus the American dollar at this moment. That's a decline of 1.7%. To talk about it further, let's bring in an expert. He's Adam Button, Chief Currency Analyst at ForexLive. Adam, thanks a great deal. The story here, of course, is, I guess, more to do with the greenback than the loonie. The greenback, the U.S. dollar, is soaring today as a safe haven as investors get out of many other assets around the world.
It's really turned into a banner day all around for markets here. And if you go back just about 12 hours, everyone was feeling pretty good. Chinese data came out. It was strong. Stock futures were higher. Oil was up $3. Now we have oil down $10 and the Canadian dollar plunging. It really started with the euro. The euro earlier today broke down to the lows, 20-year low, and we just started to see a dollar bid sort of materialize on that. Now, what's been happening in Europe is natural gas prices have been going higher and higher, along with electricity prices. And the market is increasingly seeing a very difficult recession hitting Europe and the possibility that Russia cuts off gas supplies altogether, which would be obviously terrible for European growth, European industry, and then that has knock-ons to global growth as well. And, as this is sort of catalyzed today, we've seen just an intense flight into the U.S. dollar and the Canadian dollar getting dragged down with it, oil, really any kind of risk assets getting absolutely dumped here.
So there are a number of factors, of course, that at any one time weigh on or boost the Canadian dollar. Oil is one. You've mentioned that. It's down substantially. The U.S. dollar, of course, is crucial when we measure the greenback and the loonie together. What about expectations for the U.S. Fed and its path of rate hikes versus the Bank of Canada here? That relative view of the two banks is also crucial. Has that shifted at all recently?
It's shifting dramatically. I think, we've seen this cycle just be absolutely wild. The Fed or other central banks promising to hold rates low until 2023 or well into 2023, and then pivoting and now saying we're going to hike very, very quickly. And now the market is saying, well, hold on a second. We see 2-year yields in the U.S. at about 2.8%. They were up about 3.5% just 13 trading sessions ago. So the market now and the Fed funds market, if you were to drill down more, is saying, you know what, they might stop hiking around 3.325, 350, and maybe not even get there as this gets worse and worse. You see oil prices fall today, and you're seeing signs that demand is slowing faster than policymakers had thought, which is going to put downward pressure on prices. So we may have already seen the peak in inflation, and now we're just waiting for central bankers to pivot. And what's so scary about a day like today is there was nothing really to kick it off. There was no headline. You're just sort of seeing markets kind of puke here. And, at times that tends to be a bit of a bottom signal or a signal you can lean against.
Where do you think the Canadian dollar should be trading when markets stabilize and when they're not as volatile and convulsing as they are today?
I think the Canadian dollar has got this right directionally. I think we still can see it drift down for another 3 or 4 months, maybe to that sort of 73 cents kind of range. We're breaking out here now technically. So we had this these levels kind of right around where we are have held a couple times in the last 2 months, but now it's breaking through. That's the same sort of thing that happened in the euro earlier today, and then these things can tend to snowball, especially seeing as oil's down $10 in a huge reversal on the day. So we'll see some more declines there. The market is trying to shape or get a sense of if a recession's coming, if it's more of a technical recession, there's going to be a real sharp drop in demand. And from my view, we hear recession, we think of the financial crisis, we think of the pandemic crisis. Recessions come in the plain vanilla variety too, where we just see things kind of normalizing around the old growth path. Demand got a little too hot during the pandemic for goods. Some things were skewed. Rates were too low for too long. It will bring things back into alignment. It would be a little bit weaker than here, but I don't see huge job declines. For Canada in particular, the housing market is a concern. And we'll see where that shakes out. And I think that will probably determine the next leg in the Canadian dollar. But global growth will be fine next year.
Crude oil down, as you note, by close to $10 per barrel today. It's still high historically, however. It's a lot higher than it was a couple of years ago. There's a look at West Texas Intermediate crude. It's still up, even after today's decline, up by 32%. Do you have a longer-term call on global oil prices?
Yeah, I mean, I couldn't be more bullish on oil. I think the story here, even on today, is supply against demand. The oil market is undersupplied. Obviously, demand is falling here, and demand has been destroyed due to high prices, especially in emerging markets. So I think ultimately oil ends up going much higher from here, and Canada will truly benefit from that. But a day like today can break the back of what's been a great sort of short to medium term rally in oil. So I'd be a little more cautious here, seeing as it's below 100. But there's some good support around 95 in oil. And I think after this all shakes out, it should stabilize around in the $95, $90 range.